Hi, everyone, and welcome to this Mail and Guardian webinar on investing in a COVID-19 world in partnership with Citadel. So, Citadel, thanks for being willing to innovate and embrace this new way of doing things. Coming from our various living rooms around South Africa, you get to glimpse into our homes at this time where Zoom meetings have become the de rigueur, the new normal. And I'm reminded of a Walmart update that was, I think, 3 weeks ago that revealed there's been an unprecedented spike in the sale of tops and not a matching sale of bottoms. So it just shows you the world that we're living in. And I think I've heard the word unprecedented mentioned more times in the last 30 days than I probably have in my entire life prior to that. Now, what we're trying to do with this webinar is to give you, the investor, a framework with which to navigate these unprecedented times. And I'm reminded at this time of Jason Zweig. He's the author of The Devil's Financial Dictionary. He's a columnist for the Wall Street Journal. And I think particularly apt at this time. Forecasting is the attempt to predict the unknowable by measuring the irrelevant, and the task that employs most people on Wall Street. And it just goes to show how difficult it is to say what tomorrow is going to bring. But we can certainly ensure that we are less wrong by applying a sound economic and investment framework. And just as a high-level introduction, I think that's really what we're trying to do today. Just some housekeeping rules. Participants that are part of this webinar are not going to have access to speak directly to Maarten, but you're welcome to type your comments and post questions in the chat session. We'll moderate some of those and put those to Maarten throughout the next hour. He will respond as best as he can. There's also a poll on the screen. The answers will be graded, so be sure that you answer correctly. No, it's a poll just to really get an indication of results, of the feeling and the sentiment out there, because I think sentiment is very important at a time like this. And that poll question is 3 choices, really. What do you think is the best and the most appropriate at this time? Are you a seller? Are you a buyer? Or are you holding tight? And really, when you distill markets down, it's as simple as that. Doesn't it sound like the easiest thing in the world to do? Well, if it was that way, we'd all be Warren Buffett, and we probably wouldn't be tuned into this webinar right now. A lot more complicated, but interesting to see your thoughts as you've entered this webinar to find out whether or not you think we're in a buyer-seller's market, or whether you're just holding tight at the moment. Just lastly, the recording will be available post the webinar. So if you do want to download a copy or share it, feel free to do that. Right. I thought just to set the scene, I went back into my program notes for Classic Business. By the way, I'm Michael Avery from Classic Business. For those of you who are unaware or don't listen to the show, hopefully you'll start listening after this on Classic FM or Fine Music Radio, and you can also catch me on Business Day TV middays. And I was going back through my program notes and had a look at the high on the S&P 500. It was on the 19th of February, reaching all-time high. It marked the top of the second longest bull market in history, and we saw the top 40 on the JSE above 52,000. The rand was at 15 to the dollar. But by the 3rd of April, that's a mere 32 trading days later, the S&P 500 was in a bear market, down just over 26% from the peak, and one of the quickest turns into a bear market that we've seen in history. But now, this past week, and perhaps a little bit longer, we've seen market participants betting that stimulus bazookas are going to kill all of the corona-getting concerns that we've had. So where are we? It does seem that there's a lot of volatility, a lot of irrational exuberance might be the word for it as well. And as I hand over to Maarten Ackerman, Chief Economist and Advisory Partner at Citadel, I just remind you that a bull market is when you get stock tips from your barber. A bear market is when you get a haircut from your fund managers. I'm sure many of us are probably needing a haircut at the end of this lockdown. Maarten, over to you.
Michael, thank you very much. It's a privilege to be part of this webinar. And yeah, as we discussed before we started, we don't want to run through a pack of slides and bore everyone. So I'll set the scene in a couple of minutes, and then let's get the debate going with questions and answers. So to get us going, let's get this presentation on the screen. So I think what is very important at this point in time, before we talk about investments, is the fact that, we're sitting where we are sitting today because of a virus, and the virus became almost an economic fundamental. So if you want to understand where markets are heading, you need to understand also what potentially can happen with the spread of the virus. So to start, I just want to give a very quick update in terms of the current numbers. It's obviously changing on a daily basis. I find at this point in time that the Financial Times is providing quite accurate and up-to-date numbers. So the first graph that I'm showing you here is just the new cases that we've seen around the world. And I think one or 2 points on this graph, the fact that China's been showing this steep decline after being locked down for almost 2 months, a little bit of an increase after that, but again, back to very, very low numbers as we speak. It seems that most countries that followed a similar kind of approach, even the US that started quite late, we are approaching peak infection. So that is very positive because it implies that, in time we will be able to get this under control and we will be able to open up economies around the world. If you look at the next graph, the next slide, this is the number of deaths, and you will see a similar picture there. Although some of the countries at the top took a little bit longer to implement the same measures as China, we can clearly also see now that the curve is flattening, and they're probably going to follow the same trajectory as the Chinese shown on this graph over the weeks to follow. So that is positive. That is one of the reasons why, since the low in global markets, when was it, last week in March, we've seen a significant rally to date. And we'll get back to that because, that's just a relief rally almost in terms of the fact that there's an indication that we're approaching peak infection in some of these countries. Just quickly on SA, we're all still in lockdown. It's one of the most strict lockdowns in the world. But if you look at our curve, then it seems like it's also working. It is flattening. There's been concern at the earlier days that, we might not see the true picture just simply because we haven't had enough tests being done at that point in time. But that's been increased rapidly over the past couple of days and weeks. And as a result of that, you will see that the daily new cases definitely increased of late. And that's purely because we are testing more people. You can see that increase that we've seen before the lockdown. And then obviously for a number of weeks, people stayed home. We haven't done enough tests and we got everything ready to go. And then we've seen an increase in the number of cases. But the same kind of conclusion that being in lockdown now almost for 5 weeks, we will be able to flatten the curve. And as you're all aware, from Friday, slowly start to open up the economy. So that's just a very quick update on the virus. Just 1 or 2 graphs on the economic impact, and then we can start opening the floor for questions. If you look at this picture, obviously, I don't need to show any graph. Everybody understands that if that's the economy we're looking at this point in time, it is very negative for consumers, for employment, for companies, for profitability. And again, we're only starting to see this pain as we speak, yet markets are rebounding quite strongly. So we need to ask the question, how long can that continue? Just 1 or 2 economic graphs. We can again use the Chinese economy as a point in case. The red line here shows your PMI, your Purchasing Manager Index. You will see that as they went into the crisis, it dropped significantly to about 30. And then as they started opening up the economy, a strong rebound above 50 again. Anything above 50 show that they're expanding. But remember, we're measuring that expansion from that low. So yes, they're obviously expanding from the low during the crisis, but we're not back to full capacity yet. Manufacturing probably back to 90% capacity, services only 75%. And that's purely because, you can imagine consumers are cautious. They don't want to go to restaurants yet, get back on public transportations and the like. If you look at the GDP numbers, similar kind of negative print in the first quarter. And you probably heard a lot about V, U, L-shaped recoveries. It's not really about the shape of the recovery. I think this is just indicating to us that, yes, number one, if we get the virus under control, and number two, if we start opening up these economies, a rebound is possible. So that's the point on this. It's still early days, but the Chinese example is a good example. A very, very busy graph, but I just want to take us into the States, into the US. The orange line here is a leading indicator, so it gives us an indication of what the US economy is likely to do 6 to 12 months ahead. You will see that every time when this orange line goes below zero, this line in the middle, then it's followed by the shaded area. The shaded area is a previous recession. You will see that the orange line now suddenly dropped significantly below zero. That's an almost vertical line that you see there, indicating to us that the US is definitely in recession. We haven't seen 2 negative quarters yet, but that will happen in time in the next 2 quarters. But my concern here is that if you look at the other 2 lines, the green and the black, that's company earnings or company profitability in the US and the rest of the world, is highly correlated with this economic cycle. And this suggests that there's a lot of downside pain still for company earnings. And yet, again, my point that markets are flying at this point. Only 2 more slides for now. This one shows the global economic growth over the past couple of years, the black line. And then we've added some of the consensus numbers in terms of what we can expect for the next 3 years. Again, it looks like a V-shaped recovery, but we're only looking at annual data. I think it will probably take a little bit longer, call it a U kind of recovery with a couple of weak quarters and then getting more positive quarters and then back to capacity. But I think the important thing that I want to highlight in this graph is that for the last decade, that dotted line shows that we had average growth in the world around about 3.5%. Then if we assume quite a deep recession for this year, a rebound going into next year, and then moving back to capacity, the average for the next 3 years is the dotted line that you will see there. And that is quite a massive drop in terms of capacity growth, almost a 1% drop in capacity growth there. And then the same to SA, we had the last decade over the past 10 years where growth been declining all the time. We didn't benefit in that strong growth compared to the rest of the world. We understand and know the reasons now looking back. Our average growth for the last decade was about 1.5%. And then we're probably going to see a deeper recession, much deeper than 2008, because we went into this crisis already in recession. And the dotted line for the next 3 years, it's barely positive at 0.3. So you can argue that we're almost going to see no growth for the next 3 years. So given that background, before we open the floor, this is the S&P 500. And if you look at the end of last year, company earnings in the US were moving sideways. The S&P was still running to new all-time highs. At that point in time, we already warned that this can't continue forever. We were concerned about a looming US recession, obviously without knowing exactly what's going to happen around the virus. And then in the shortest, quickest time in history, the market started dropping within a month from the all-time high to the bottom. That's about a 33% decline. Company earnings, you can see the orange line is now slowly starting to adjust downward. And if you think about my previous 2 slides, there's more pain in the pipeline, yet markets are approaching much higher levels compared to that. In fact, we're now about 11% away from the previous high. So I'll leave it there for now, Michael, and we can open the floor. But that's the first point to say. We're in an environment where, although things are looking better on the market point of view, we need to be quite careful in terms of the outlook going forward.
Well, I think it's a good point to end off on for the first section, because it does seem for a lot of people for there to be a disconnect between what we're seeing in the so-called real economy and the fundamentals. If you look at the US, and as you've just painted, very poor fundamentals behind earnings. We see record unemployment there again, or heading certainly in that direction. All of the new jobs created since the global financial crisis destroyed in the space of 5 weeks. And here we see in today's headlines, in an interview with Goldman Sachs, the finance minister saying that they expect an economic decline of over 6%. Some forecasters say that's probably quite optimistic in this environment. we're often told that when there's blood on the floor is a good time to go out and buy stocks and to buy equities because the margin of safety has improved, as per Benjamin Graham. Is there sufficient margin of safety? I think as a first question, considering the fundamentals and still the uncertainty about the path out of COVID-19 and the lockdowns.
Yeah, I don't think at this point in time. So let's just quickly go back. If we talk about the S&P 500, we're currently north of 2,800 again on the index. Exactly like I've explained now, we think that's a little bit rich. So if we go back to the end of March, we were trading around about 2,300. I think at that point, if we get back to those kind of levels, the margin of safety will be sufficient for what we're probably going to experience over the next couple of years. If you get into the market, anything below, let's say 2,400, your risk reward being back into equities for, let's say, 3 to 5 years will be worth it. But where we are at this point in time, I think it's probably better to remain defensive and wait for the market to test those lower levels again. On that point, let me just show you another graph, which is also on the S&P 500. So I'll flip through this quite quickly.
As you look for it, Maarten, I just want to respond to Ian Weir, who's just asked that we make the webinar available after it's complete. Ian, thanks for joining us. You joined a little bit late. I said in the introduction, a recording will be made available, so you will have access to that. And perhaps I can also, Maarten, just mention the poll so far. Quite clearly, the majority think that sitting tight, holding tight, sitting on your hands and doing nothing, 70% is probably the right strategy right now. Around a quarter, 27%, reckon there's a good buying opportunity. Not many sellers in the room, only 2%. So I think that certainly is a good gauge of where the audience thinks we are in terms of the cycle.
Yes, I think it also depends, obviously, which asset class you talk about. But for the moment, sticking to equity, here's the S&P 500 since the 1900s. It's on a log scale, so every up and down is to the same magnitude. And this makes my point again. If you look at that decline that we've seen this quarter, and we expect a worse outcome compared to the financial crisis in 2008, then you need to ask yourself whether that's enough price into the market compared to what we've seen in 2008. So that's the first point to say that there's probably more downside, if we are going to see double-digit unemployment in the States, company bankruptcies, and a lot more pain for companies and consumers. But while we're also on this graph, I think it's important to say that we're probably not at this point in time heading for a depression. Go back to the depression, you will see 2.5 years the market declined, almost lost 75 to 80% of the value before the recovery started. The fact that the evidence, like I've showed, from China opening up again, and it will be the case in other economies as well, suggests that even if we in lockdown a little bit longer, but as soon as we open the economy again, nothing is broken. We haven't been in a world war where we've destroyed everything. And we've got a significant amount of stimulation. So we can actually then get back to a rebound. So we do see a rebound going forward. But I think, like I've mentioned, we're only starting to see earnings report coming out. And I think the market has been running a little bit ahead of itself at this point in time.
I think a very good question here from Peter Bendheim, who says that his portfolios, which are with Citadel, have declined to the point where his original capital has been eroded somewhat. I think that's the experience of everyone in the market right now, from billionaire hedge fund managers to ordinary pension fund investors. What we saw in the most recent sell-off was an indiscriminate selling of every single asset class. It was a rush for cash. So if you had cash, you were okay. But we've seen commodities, gold, which is usually a safe haven, was sold off in the recent rout. We've seen equity sell-off. We saw bonds sell-off. So the traditional safe havens didn't even provide any protection. What would your advice be to an individual like Peter? He's saying, should I just ride out the storm?
That's very client specific. So typically we will sit down with a client, understand their cash flow requirements. Typically we will go into a storm like this. I'm talking about Citadel specifically, where the client will have enough cash to cover their expenses for the next 2 years. And then safe investments, typical fixed income kind of investments for the next 4 years. So you'll probably be okay for the next 6 years. So although you will see, call it a paper loss on your portfolio report, a lot of those assets you don't need to touch to provide liquidity. So you can actually wait for markets to recover. And like I've mentioned, you've got 6 years plus to wait for that. And only when you get your growth equity kind of assets back in profit territory, you will start to take profit there and fill up the buckets that's more stable. So again, very client specific. So the general advice is, in a crisis like this, stick to your plan. Don't get too emotional, because you'll make the wrong decision at the wrong time. You will sell right at the bottom and buy right at the top. What we're trying to do right now is to not make aggressive changes, but obviously, like I've shared already, have a view in terms of what might play out over the next couple of quarters and even year, so that you can adjust your portfolio accordingly and look for opportunities. We'll talk more about it, but in a crisis like this, something like the currency, the rand, presented some significant opportunities that you can lock into your portfolio. Our own bond market is currently presenting a very good opportunity. We can talk a little bit more about that. So you need to always look for those opportunities, but definitely not sell all the equity and just sit in cash at this point.
On the fixed income / bond side, we have seen the South African Reserve Bank's response to what's happening in the real economy be one of slashing interest rates 200 basis points over the last month or so. And that's obviously affected the returns that you're getting from some of your fixed investments. At the same time, we're seeing South African bonds, as to your point, offering a very attractive yield at this point. So I suppose my question to you at this stage, at what yield would you buy South African 10-year bonds, considering the inherent risk, obviously, the ratings downgrade we've just seen, and the fact that we're going to be exiting the World Government Bond Index in a couple of days?
Yeah, I think we've been very light on bonds, significantly underweight the asset class, because we were very concerned about the fiscal picture in South Africa, and obviously the impact a downgrade can have on the asset class. Subsequent to the downgrade, or around that period, we increased our exposure quite a bit. There's probably a little bit more volatility as we approach the end of this month, where we will be excluded from the bond index. But this graph, to set the scene, is what we call the South African yield curve. So it's only the difference between our very long bonds, the 30-year bonds and 10-year bonds. And you will see that as we went into 2019 already, foreigners, or not foreign, any bond investors said that there is a risk, a fiscal risk. And to compensate them for that, they said, well, we're more than happy to lend the government money, but you will need to pay us more interest to cover that risk of the fiscal situation. And there you can see how much that spread opened up. You probably can't even see it because it's vertical on the scale here. But this is the increase in our fiscal risk, so to speak, that the market's been pricing in. So where we are right now, we can argue that most of that risk of the downgrade's been priced in. Again, like I've said, there will be some movement around the rebalancing of the index, but most of it's already in the price. So we argue that if you start buying at these kind of levels, you get a double-digit yield. And, we're in an environment where interest rates are declining, as you said. So in time, the long part of the curve will also start to decline. If you look at other countries like Brazil, the examples being that, after a downgrade, they actually moved back to more normal yield levels, lower than just around the downgrade. So that will add, over the next couple of 3 years, also a bit of a capital gain to those investments. So our view at this point is that, you get a double-digit yield in any case. You get a bit of a capital gain as yields start to move back over the next 3 to 5 years. So you could probably get around about 12 to 14% per annum nominal return in South African government bonds, which, if you think about other alternatives anywhere in the world, is very attractive. Now, while we're on that, if you buy that in a kind of pension fund product, a retirement annuity, a provident fund, where you don't pay tax on the interest, and you compare then your real yield where, inflation is sitting at 4 something, and it's probably going to be a little bit lower as we go into this disinflationary environment. So you're banking probably with the highest real yield in the world at this point in time, making use of that opportunity. So I think at this point there is a good opportunity in the fixed income space in SA, and even better if you can put it into a retirement kind of vehicle to save the tax on the interest.
Why were you like government bonds then?
Why would I like government bonds?
No, why were you light? You said earlier you were a little bit underweight going in.
Yeah, no. So we were light because we expected the yields to spike. So remember, over the past quarter, the JC declined double digits, but so did our all bond index. And that was as yields moved up, we've seen the capital losses. So, after the October budget last year, the writing was on the wall that it's not if, but when we're going to be downgraded. The same with the February budget. And as a result of that, we expected the sell-off in the bond market. And we were very short duration, and we kept a lot of cash on the side. So that's why we were light on the asset class. But like I've explained now, during the course of the past couple of weeks, we're now back on duration. So we made use of this opportunity to now buy into those bonds at these much more attractive yields.
I want to move on now to your view on the currency. And obviously, it's the favorite dinner conversation, braai conversation, when we can go back to having braais again. And that is the value of the rand. Many people seem to think and believe it is oversold at these levels. It was one of the better performing currencies over the last few days by Bloomberg tracking emerging market currencies. We know it's very liquid, one of the most highly traded emerging market currencies in the world. So very often is a proxy for what's going on in the attitude towards emerging markets. Where would you see a fair value for the rand?
Yeah, so I think, the rand is caught in the same storm. We've seen a lot of weakness around the downgrade. We will probably see more weakness in the weeks ahead as they rebalance the index. We see a little bit more capital flowing out from the bond market. But just a couple of things on the rand. So the graph that you're seeing right now, the black is the rand dollar exchange rate, and the red is our peer group. So that's all other emerging markets, India, Turkey, Brazil, you name it. So the first thing is you can see that there's a high correlation between the two. So, to think that the rand is only impacted by local events, it's not true. The 95% of the value of the rand is impacted by global factors, global capital flows, the view on the dollar or the view on the monetary policy in the US, and also what the Chinese are doing in terms of stimulating. So if you look at this graph, you will see that when Cyril Ramaphosa became president, we definitely broke away from the peer group. So that's what they've called the Cyril Ramaphosa premium. We've kept that gap for quite a while. And then this year, we've basically moved back in line with the rest of the peer group. So 2 points here, everybody actually weakened, if you look at the red, in this risk of emerging market environment, money flowing to safe havens, mostly US bonds and the US dollar. That impacted all emerging market currencies, including the rand. But we obviously took a little bit of a bigger knock because we first had to make up, call it that lost ground, if you like, to get back to the peer group. Now, this doesn't mean that the Cyril Ramaphosa premium faded because of any, performance from the president. In fact, I think he's performing much better during the crisis. His popularity is increasing. But this was more the market saying that even, if Cyril Ramaphosa performs and do everything that he needs to do, the fiscal situation is just so bad that we're probably, going to experience a lot of pain going forward. And that's why that gap closed. So that's where we are right now. So the first point is we're not alone. Then if we look at the second graph, that is the rand, a little bit longer term since 1995. The red line in the middle is the interest rate differential. So that's a difference between us and the States. It's normally about 5-6% per annum. So if you close your eyes today, for the next 10 years, this trend is likely to continue. But you will see that the rand very often breaks out to the top or the bottom. It never stays there. It always gets back to the interest rate differential because in reality, once the dust settles, investors will look at this and say, but hang on a minute, you can sit in dollars or in rands, but what interest do you earn in both of those? And then capital will flow in that direction. So again, the rand weakened significantly going into this crisis and around the downgrade, and we're sitting close to 19 at this point in time. Clearly, we're above this kind of long-term deviation range. So the view on the currency is to say that in the next couple of weeks, especially around the rebalancing of the index, we can expect the currency to remain under pressure and probably get even weaker, probably get to the weakest level we've seen so far. And what that level is, who knows? That will be determined on the day in terms of market liquidity, but let's say 1950 to 20. But then, our view going forward is that the currency is likely to strengthen, to move back to this long-term fair value. And probably by the end of this year, we could sit with a currency closer to 17. And part of the reason for that is not, because of anything happening on this side, but during this crisis, that weakness that we see in emerging market currencies is actually dollar strength. So capital went into what you've also mentioned, the safe haven, a lot of demand for dollars. Yet in a couple of weeks, they've dropped interest rates to zero. So, investors very soon will look at their dollars and realize, but, we earn zero interest rate on this, and then we'll start looking around the world again. So as the dollar runs out of steam over the next couple of months towards the end of this year, that will create the environment for the rand and other emerging markets to gain ground again, back to what I've said, probably a level of around 17. So look for weakest level in the next couple of weeks, and then a slow drift back to more normal levels, probably around 17 or slightly below that.
And Maarten, on the issue of interest rates, there's a question from Helen Jacobs here, and obviously the SAR being very proactive, coming out with two big rate cuts, 100 basis points each, after quite some time being accused by market participants of being somewhat behind the curve, being overly hawkish. We've seen the dove certainly come to coo around the Black Tower. She's got her home loan bond fixed at present. Would you suggest that Helen applies to get the fixed rate now and perhaps pay penalties, or do you foresee interest rates climbing again in the near future? And obviously, without knowing Helen's specific circumstances, I think the broad question there is, what do you expect interest rates to do over the next 12 to 24 months?
Yeah, I think, let's start with that. We're in an environment where there is enough room for the Reserve Bank to cut more. Obviously, the economy is needing it. And as we exit the lockdown, any support that we can get will help a lot. So the environment is definitely ready for more rate cuts. That's the first point. The other point is, the Reserve Bank is focusing on inflation. And inflation at this point in time is, below the mid-range, if you like. And given what's been happening in the world, despite the weakness in the currency, we know that over the past couple of years, the pass-through a weaker currency doesn't mean that we are going to see high inflation anymore. That impact's been reduced quite significantly. Also, we've got very slow or lack of demand at this point in time. We've seen what's been happening to the oil price. So if you exclude maybe some of the administered prices in South Africa, now our inflation is probably below 2%, and it's going to remain quite low for a long time. So that creates the environment for the Reserve Bank to actually cut more. So I think we definitely in a declining cycle until we get to a stage where there's more stability around the world, and we do see some normalization of monetary policy. So that gives the Reserve Bank that room to maneuver. So in a declining interest rate cycle, even if interest rates are remaining stable for some time, if you go back to investors with bonds, in that kind of environment, you probably don't want to fix your bond rate. You will very often see that banks will make a good case now why to fix it. But in reality, it's because they also expect a declining cycle. And if they can fix rates now, that gives them a bit of extra margin going through the cycle. So without giving any advice on that, because it is client specific, but I do think for the next 12 months, we're probably going to remain in a very easy and probably a little bit more easy monetary policy environment in South Africa.
So you've then got to do your own sums and see what the penalty cost is versus the savings that you're going to get from getting that
Exactly. Yeah.
flexible rate in a declining environment. Another broad question here from Grant Newland-Nell on the macros, and we just saw the big bazookas rolled out last week, 500 billion rand stimulus package, of which 200 billion is a bridge financing scheme, so roping in the banks there largely. I think 130 billion is going to be from expenditure cuts in the budget. So as far as possible, fiscally neutral. There is still going to be some borrowing. Government's going to have to come and borrow more. With all of that, what's your view on the impact of this on the government's finances over time?
Yeah, unfortunately, 500 billion, you can slice and dice that cake and then really ask the question, how much of that is actual stimulation, new money? It's one thing if you say that you get 80 billion by cutting interest rates. That's not really new money. It is a way of monetary stimulation. We can probably go and borrow a little bit more from external parties, 200 billion from the banks. That's a facility that's being made available. And the 130 billion from the budget is also, it's money that we would have spent in any case, but now we're going to be more focused in terms of where we spend it. So I think, the number is what it is, and we will get it where we need to get it. The question is, will it have an impact? There's actually three things. The first thing we've been doing for the last 5 weeks, and that's just to get the virus under control, get our medical supplies online, have a plan that we can execute on. It's very important to realize that after Friday, it doesn't mean that, we're going to see a decrease in infections. I think, in fact, we're going to see an increase, but now at least be ready from a medical point of view. The second thing is to, provide relief in the middle of the crisis, and that's what the stimulation is about. And I want to show a graph there, especially in terms of the social impact. And then the stage 3 that they're also talking about is the next phase, and that's really to reform the economy and then kickstart the economy through a third phase of stimulation. Now, I just want to get to this graph quickly. So if you look at this graph, this is South African economic growth, the black line, over rolling 3 years. Now, that sharp decline that you see there, now that's the expectation that we've put in. So before this year, we were still sitting around about 1.5% growth over the 3-year period, which was already tough. And the reason why I'm saying that is we compare this normally to the red line, which is the growth in population. So if you go back to the 90s, we were also in an economic slump where for 3 years in a row, we had negative growth, around about 1.8%. And yet the population was growing around about 2.5%. If the number of people, the red line, outstrip the growth in, call it the cake, then you've got social issues. So we also had unemployment around about 25% and growing. Now, if we go back to the last 3 years, unemployment's been increasing in South Africa. We're now sitting close to 30%. And the main reason for that is because the economic growth started to drop below the growth in the population. So before we went into this crisis, we were hopeful that the first thing the government needs to do is just to get economic growth back to the growth in the population, which is around about 1.5%. That is something that's doable. And then, we can cap unemployment. Now, unfortunately, we're in this environment. So if you look at that gap opening up before there's any potential recovery, so I'm talking about 2020, we can expect a lot more poverty, more inequality, less inclusive growth, unemployment probably going close to 40%. And this is what that stimulation package tried to cushion, to make the impact from a social point of view less severe. So I think the numbers are what it is. We need that to make the impact less in terms of the social impact. And then hopefully, if you go back to that other graph that I showed in terms of the potential recovery, then after we open up the economy again and we get to this stage, that there's a third stage of stimulation, but not just stimulation. I think government made it quite clear that now it's also time to remove the structural issues, to do the necessary reform, to actually prepare South Africa to benefit from any potential rebound. And again, it doesn't matter whether it's going to be this year or next year or when it's going to start, but if when the global economy starts to rebound, we need to be ready as well to benefit from that. And that will then in time help us to again reduce that gap and get unemployment under control.
And I think that's the big unknown at this stage from a macro perspective is, will we be in a position to surf that wave of growth when it happens again? What do you see happening to government's reform agenda in the next 12 months? Do you see it accelerating, decelerating, staying the same? There's been a lot of talk from the finance minister that now is the time to grab the animal by the neck. He doesn't want to talk about ideology. He wants to slay those ideological shibboleths. We've seen in the party a reticence to go and approach the IMF, for example. That's now been put to bed. Does it look like, and back to your earlier point, the president has sufficient political capital now to accelerate the reform agenda? How do you see that playing out?
I think even before the crisis, everybody's been calling for more radical reform, a little bit faster action. I think, a couple of months after the election, people said they expected slightly more in terms of reforms. And the crisis sometimes, not just for us, but anybody around the world, is almost like a wake-up call to say, but what is really important and what do we need to do to actually get things going? So the leadership style that we've seen from the president during the crisis, dealing with the medical crisis, been very positive. And hopefully we will see more of that in terms of addressing the economic concerns as well. I want to add to the points that you've made already. I think that government is taking a more hard kind of line in terms of some decisions. We know that early on they didn't honor the wage increase agreement that they've got 3 years ago. No more funding to SAA, although they're still talking about is there anything they can do about it. But at least government is not providing any further funding at this point in time. So even if we do see, and I think what's important is that once we've got the virus and that crisis around that under control, and we really want to get the economy going, probably more urgently than at the beginning of this year, we need to see the proper reform taking place with the backing, whether it's monetary or fiscal stimulation as well. And, it's one thing talking about it. We said it before many times. What we really need now is action. And I would dare to say that I do think there's already a little bit more action than what we've seen before, given the urgency of the situation. But despite that, I think South Africans need to be aware that we're in for a very tough environment, probably a more difficult environment before it will get better. And back to the previous question about government debt, in this kind of environment, government debt will exceed any numbers that we've seen before. The amount of interest that we'll pay will be quite significant. That will take away from other important things in the budget. But if we can get the economy going, we will get to a point where at least we have a more sustainable fiscal path. But to do that, we will need, like you said, reforms within the next 12 months. We can't wait any longer. Otherwise, it will be heading for depression in South Africa.
The one thing that I'd like to add on to that, Maarten, from my perspective, I've seen an openness and a transparency from key government ministers and ministries, line ministries, that as someone who's been in the financial media for almost 2 decades, I've never seen before. I'm certainly seeing that being driven from the top down. We just hope that it doesn't revert back to the mean after the crisis is over, and we can use this momentum. They say never let a good crisis go to waste. I just want to remind participants just quickly, Maarten, okay, the poll is going to be closing in the next minute. So please, if you can get onto the poll vote, we're going to close that in the next minute. Maarten?
No, I just want to add to that. I fully agree with you. What's also been as a result of the crisis, the relationship between government and private sector improved quite a bit. And the private sector is, willing and able and been very, very part of finding solutions for the health crisis. And I think that was all very good in terms of also being closer to government as we exit this phase, to play a bigger role in terms of healing the economy. So the fact that the private sector and government, as a result of the crisis, also got closer together is very positive.
Right, just having a look at those poll results as we close off the poll. Barely moved from where we started out. Holding tight, 71%, buying 26%, and selling at this stage in the clear minority at 1%. Just as we reach the back end of our conversation, the time has certainly flown, Maarten. Another big question for investors, and it has been for the last 5 years, even pre-COVID-19, was how much of my assets should I be shifting offshore? This was on the back of that unprecedented bull market in the US, and many people feeling like they were missing out on that. We had gone virtually sideways on the JSE for the last 5 years. How has COVID-19 altered that dynamic? Is now a good time to be going offshore? Is there a lot more value onshore at the moment? What's your view?
Okay, let's normally when you talk local offshore, the currency is immediately, the point to debate. So let's just park the currency for now. I'll get back to that. So I think where we are right now, we think that SA companies, the JSE is likely to remain under pressure. We need exactly the same kind of economic reforms to get the economy going before we will see the JSE benefiting from that. So yes, the JSE is a very diverse index. There's a lot of value opportunities. We've got a lot of rand hedges. We've got a lot of SA Inc., SA only companies, which unfortunately will take more pain, if the consumer is under pressure and until we see some of the reforms that we spoke about. So I think, for the next 3 to 5 years, the JSE will have some headwinds to deal with. But that doesn't mean that there's some bargain opportunities that one can pick up. Then if you think about the fixed income space in SA, which we spoke about already, the bonds, that's very attractive yields. So I would always argue and say that, you need to buy your yield in SA, but your growth abroad. So more global equity exposure. And the reason why I'm saying that is you will get more diversification. You'll buy into industries and regions that we just don't have. And you will buy into economies that's got more ammunition to stimulate, which is doing that already. And those companies are likely to benefit more from earnings potential compared to some of the local companies. So probably some overweight global equity versus local equity, but definitely making use of the yield opportunities in SA, just broadly speaking. Then just quickly on the currency. So if you want to take money abroad, we just said that the currency is approaching probably one of the weakest levels on record. So yes, there will probably be a better opportunity to go and buy dollars over the next couple of months towards the end of this year to actually buy the dollars to take abroad. But again, there's a lot of tools that one can use, and very often we don't want the currency to stand between us, between the client and an investment opportunity. So as an example, you can move money today at 19 to the dollar. You can get it into whatever investment you want in the international market. And then you can have a currency overlay where you buy the currency forward. It's a little bit technical, but it just simply means that you protect yourself against the currency going from 19 back to, let's say, 16. So the currency we can manage actively after you've made the decision that, there's a better opportunity abroad and I want to tap into that. And then you just manage the currency depending on where it is at that point in time. So yeah, I think where we are at this point in time, there's definitely opportunities in SA, but we would probably like a little bit of an overweight into offshore markets, simply from a growth potential, a diversification potential, industries that we just don't have, and less structural issues for those companies to benefit from that.
Yeah, things like biotech that are very well developed, and the venture capital growth stories that we see out of Silicon Valley. That said, one of the questions from Marlies Meyer is company specific, but I want to maybe zoom out, no pun intended. She asked, should we be investing in technologies like Zoom? I've never Zoomed so much in my life. In fact, I find myself getting sucked into that vortex daily. It's too easy to get into a Zoom meeting. But it's an interesting question from a thematic area. What thematic sectors would stand to benefit in a post-COVID-19 world? One would automatically and intuitively assume that digital technologies, online technologies are going to get a boost from social distancing and this new way of working.
Yeah, I think the world after COVID is going to be different, and I really hope so. I hope that we don't learn no lessons from this experience. It's unfortunate that we needed something like this to break some of the old industrial habits. To get in your car every morning and drive to a workplace where you can actually do it online. The digital economy has been ready for this in any case, but now we've been forced to actually just tap into that. So I agree with you. I'm probably spending more time in Zoom meetings, but I prefer that instead of sitting at the airport in a business lounge. So it's much better to sit in a Zoom meeting than in a business lounge. But having said that, I think you could probably summarize it very, very quickly by saying the winners after this will be online, and the losers will be offline. And you can add to that, probably things like airlines as well. So the world is going to change. We will still travel. There will still be tourism. But I think a lot of the business travel will be, people will think twice about just flying up to Joburg for an hour's meeting or so. So I do think, the opportunities will definitely be more in the international, into the online space across the range, but also in terms of medical and biotech, like you've mentioned, after 9/11, the budget that we spent on fighting the enemy, which was terrorism, it's been huge, and a lot of those industries benefited from that. I do think after this, we've got a new invisible enemy, and the amount of money that will go into medical research for future kind of events like this will definitely support some of those sectors. So, we don't have enough time to go into the nitty gritty, but, generally speaking, I think online medical will definitely benefit, and some of the older industries, which was also not always helping in terms of the global health, of planet Earth, in terms of global warming. Those kind of industries will take a little bit longer to recover, or might recover in a very different format as what we've been used to before COVID.
Yeah, as we're already seeing in the oil market, I think it's a medium-term conversation that we're still going to have, the impact of climate change as a contributing factor to the rise of prevalent pathogens like SARS-CoV-2 and others. That's certainly not going anywhere. I just got a message from Dave here who says this is all sounding just a little too optimistic for his liking. He wants the bear case. He wants to know what are the risks to these outlooks, and it's important to have a look at it from that perspective.
Now, definitely, I think the downside scenario is this: that we're heading back to a global depression. I already mentioned that, unfortunately, in SA, just given where we started from, it's probably more likely here than abroad. So this is a downside scenario. So, if we see a significant second wave, and we haven't learned everything from the first wave in terms of being proactive and closing down quite soon, or if, economies need to be locked down much longer, then something like this becomes more likely. At this point in time, and I'll show you one or two graphs now, we think it's still quite unlikely. We've got a depression scenario less than 15%. And the reason for that is basically, if you look at the 1930s, we had an economic decline of minus 8.5. It's been followed by another year of minus 6 and another year of minus 13. So that's when you end into a depression scenario. Unemployment, we could very easily get back to that kind of number in the States, given how quickly they've been firing people over there, heading into the crisis. But why are we not on this page at this point in time? And remember, in an environment like this, if that plays out, that's your bear case scenario. Then this 30% that we've seen to date in decline is not enough. And we will probably see markets testing much lower levels. Like I said, in the depression there was almost a 75% decline. The reason why we don't think it will happen, again, I think economies will be able to slowly start opening up, which means that we can see positive growth in the years to follow. But this is probably one of the most important ones. If you look at the amount of stimulation, and currently we more than $7 trillion combined across the world. This is only showing the US budget deficit. the expectation for this year. So it's approaching 20% of GDP. Now you will see that that's the same amount of money that we've pumped into the economy during the Second World War. Slightly less, but at that point in time, that was used to actually fund the war, but also after that to rebuild everything that they've destroyed. This time around, if we open up, even in a year from now, there's nothing that's destroyed, and you've got all the stimulation that can help the economy get going. So I guess to answer the listener, the bear case is heading for a depression, but we monitor this every day, and given the stimulation, we think that risk is still quite low, but it doesn't mean that markets can definitely test the lows that we've seen so far. But we're not on the depression page yet.
Yeah, it's not as structural. It seems to be a much more event-driven crisis, this, and we do tend to recover more quickly from event-driven crises. We've got a few more questions. In fact, we've got tons of questions. We're not going to get through all of them. One from Gwen Ramakopa. I don't know if that's the former MEC for Health. But welcome if you are joining us, former MEC. Any comments on cryptocurrencies and alternative asset classes? And we've been told for a long time that crypto is going to be the new gold. It's a new safe haven. It's a store of wealth. It's against this whole decline of fiat currencies, which are now not really underpinned by anything. What are your views on crypto?
Yeah, I think, it's like the internet as well. If you go back to 2000, we've seen a massive bubble in IT companies because people bought into that promise that IT will change the world. And it did. Look at what we're doing right now. That's a product of technology developments. It did change the world. But at that point in time, at the wrong price. That's why we had the bubble, because people were piling in for that promise. We've seen a similar kind of overreaction in Bitcoin or any crypto alternative currencies. It will be part of the world going forward. It will play a much bigger role. I think what is needed is some regulation. A lot of central banks, including our own, are busy with looking into that. And as soon as that's put on paper, some kind of regulation, it will become more mainstream. And I think the world is, in this kind of environment, probably more ready for that than ever before, because, like you've mentioned, people are looking for alternatives, fiat money, people printing dollars, printing rands. So what is your alternative? And it will play a big part in that. It's also in line with others like gold, other precious metals. There will definitely be a place for cryptocurrencies in portfolios going forward.
Property is one that we haven't really touched on as an investment class, and local and offshore. We know locally the REITs have been under significant pressure, and in the headlines at the moment is this big spat between the landlords and the tenants not wanting to reach agreement on whether or not they should pay rental at all or defer it. There's a big debate about whether or not REITs will even pay those mandatory dividends, or will they have to be forced to keep those in order to shore up their balance sheets? What's your view on property?
I think, if you think about the listed property in South Africa, there's obviously a lot of tough times ahead. Everything that you've mentioned now, the economy being under pressure, the consumer being under pressure, empty space, defaults, you name it. You could probably argue that how much of that's already in the price. If you look at the property sector from the all-time high to where we are now, it's almost a 70% decline. So maybe for the long-term investor buying at these kind of valuations for the next 5 to 10 years, there's definitely some upside. But, if I look at property, we spoke about the bonds, where bonds can give you, call it 12 to 14% over the next 3 to 5 years. Even if property can give me that same kind of yield, because it's also interest rate sensitive asset class, they still pay reasonable yields. And in a declining interest rate environment, they can show some capital gains. That's the way that the asset class works. So even if I can get the same kind of return, you'll take that at double the risk. So I think for the short, medium term, I'm talking 3 years, you'll probably do better in something like South African government bonds. Instead of listed property in South Africa. But then again, for the very long-term investor buying at these depressed valuations, but I'm talking 10 years plus, there is potentially upside in listed property.
Super. Well, I think we've reached the end of our hour together. I'm just reading through some of the comments from Rudy Bosman. Thanks to you, Maarten, for your insights. Ria Villiers, thanking you as well. Found it very insightful. Some people probably not as sanguine on the possibility of government's economic reform program going ahead. Isn't that the big debating point in this country? But I do think some of those reforms are going to be imposed on the government without it wanting to take those decisions. It'll be imposed through the situation we find ourselves in. More webinars, please, from Victor Tate. Thank you, Victor, as well. We had so many questions, comments, lots of feedback. So I think a huge success. Maarten Ackerman, Chief Economist and Advisory Partner at Citadel, as my phone falls off my lap here. Thank you very much for the hard work and preparation and for the insights. I found it thoroughly stimulating, and thanks to Citadel as well for supporting this new way of doing things. Why should we drive to events when we can do these from the comfort of our living room with a nice cup of tea and a few rusks and learning all the while as well? Just to remind all the viewers that we're going to be sharing the webinar with you. We've got your details with the registration, and the team at the Mail and Guardian, I'm sure, will be handling that. I suppose from me, Michael Avery, thanks so much for joining us, and we look forward to you joining us again in the not too distant future. I'm sure we're going to make these a regular. Cheers.